All right, welcome. Today, we are putting on our detective hats and grabbing our magnifying glasses because we are diving deep into one of the most critical tools in any M&A professional's toolkit, the quality of earnings analysis. So, picture this. You're about to put an offer on a company, and you look at their books and they show a beautiful, clean $10 million in profit. Looks fantastic, right? Well, in the high-stakes world of mergers and acquisitions, what's on the page is almost never the whole story. Our mission today is to become financial detectives and figure out the truth behind those numbers.
And the main tool we're going to use for this investigation is the quality of earnings, or QOE for short. Think of it as this incredibly focused, deep-dive analysis that looks right past the official accounting reports to find what a company's true, sustainable earning power actually is. It is all about separating the economic reality from the paper reality so we can validate the company's value and, maybe most importantly, avoid any nasty surprises.
Now, I know what some of you are probably thinking. Wait a minute, isn't that what a financial audit is for? And that is a great question, but the truth is they serve two completely different purposes. So let's talk about choosing the right investigative lens for the job.
I love this analogy right here. An audit, that's like a referee in a football game. Their job is to look backward, at the last quarter, and make sure all the plays follow the rules. In this case, accounting rules like GAAP. But a QE analysis, that's the scout. The scout doesn't just care if the rules were followed, they're analyzing the game tape to predict the team's real future potential. It's not about compliance, it's about forecasting what future cash flow is going to look like.
And that focus on future potential, well, that leads us straight to the absolute heart of our investigation, finding the real EBITDA. If you're not familiar, that stands for earnings before interest, taxes, depreciation, and amortization. And it's a super important metric for figuring out what a company is truly worth.
The whole process here is called normalization. It's a bit of a fancy word, but all it means is that we're methodically looking for financial clues, things that are messing with the real picture of profitability, and then we adjust for them. We're essentially trying to strip away all the noise, the one-time events, the personal expenses the owner is running through the business, to find the clean, repeatable, core earnings.
So our first type of clue is called an add-back. These are expenses that the current owner has, but that a new owner, well, they just won't. The classic example, the owner is writing off their personal sports car as a company vehicle. Or maybe they're paying themselves a $2 million salary for a job that really only commands about $200 grand. We find those costs and we add them right back to the profit line because they're not going to exist after the deal is done.
On the flip side, our second type of clue is the subtraction. These are one-time gains that make the company look way more profitable than it actually is. A perfect recent example of this was the forgiveness of government PPP loans during the pandemic. For a lot of companies, that was a huge shot in the arm to the bottom line, but it's not a core part of their business and it is definitely not going to happen again. So what do? We subtract it.
And this table here really lays out the whole process perfectly. You can see how we systematically go through the financials line by line. We're adding back things like that excess owner salary and any one-time legal fees for the transaction itself. And at the same time, we're subtracting things like a one-off gain from selling a bunch of old equipment or those government subsidies. Every single adjustment gets us one step closer to the real story.
Okay, so let's get back to our case file. We started with this number, $10 million in reported EBITDA. This is the shiny, attractive number that the seller puts right at the front of the brochure.
But we've done our homework. We've done our detective work. We've found the add-backs. We've found the subtractions. We have peeled back the layers of the onion. So what is the real story hiding behind that $10 million?
Boom, the normalized EBITDA is actually $7.5 million. That is a 25% difference. This is the big aha moment in any QE. This is the number, the real number, that should be used to figure out what the company is worth, not that inflated figure we started with.
But you know what? A great detective doesn't just find the main clue and call it a day. The true earning power is huge, but it's not the only piece of the puzzle. To get the full picture, we also need to investigate two other absolutely critical areas: net working capital and capital expenditures. First up is net working capital, or NWC. This is a crucial check that answers a really simple question. Does this business have enough fuel in the tank to operate on day one? You don't want to buy a company only to get the keys and find out you immediately need to pump in another $1 million just to pay suppliers and keep the lights on.
So the QOE process actually has this crucial safeguard built right in for the buyer. It's a simple three-step process. First, we analyze all the historical data to set an NWC target, basically the normal amount of cash this business needs to run smoothly. Then, on the day the deal closes, we measure the actual NWC being delivered. And finally, if there's a shortfall, the purchase price gets reduced, dollar for dollar. It ensures the business is handed over ready to go.
Next, we investigate capital expenditures, or CapEx. We have to know if the company has been properly investing to maintain its assets. There's what we call maintenance CapEx, which is just the necessary spending to keep the machines running, and then there's growth CapEx, which is what you spend to expand the business. If a seller has been cheaping out on maintenance just to make their profits look higher, well, the buyer inherits a massive hidden bill to fix or replace a bunch of aging equipment down the line.
Okay, our investigation is complete. We have normalized the EBITDA, we have checked the working capital, we've analyzed the CapEx. Now it is time to take all of our findings into the interrogation room, or, in this case, the negotiation table.
And this, right here, is why all of that detective work matters so much. Let's just say, for example, that companies in this industry are valued at a 5 times multiple of their EBITDA. Based on that reported $10 million number, that's a $50 million price tag. But based on our normalized EBITDA of $7.5 million, the value is just $37.5 million. That is a $12.5 million difference. This is not just some academic accounting exercise, this is incredibly powerful negotiation leverage.
So, to wrap up our case, let's put together a little toolkit for you. We want to arm you with the key intelligence you'll need to show you really understand this stuff, especially if you find yourself in an M&A interview.
Here are the 3 most important things to remember. 1. A COE is all about finding a company's true economic earnings, not just what's on paper. 2. The heart of the whole analysis is normalizing EBITDA by adding back and subtracting all those one-time items. And 3, it's not just about profit. It also protects buyers from hidden cash problems with NWC and CapEx.
And you should definitely be ready for these questions in an interview. You'll almost certainly be asked to explain the difference between an audit and a QE. Just remember that referee versus scout analogy. You'll need to be ready with examples of an add-back, like the owner's personal jet, and a subtraction, like a one-time government grant. And finally, be ready to explain why that NWC analysis is so critical, to make sure the business is ready to operate on day one without any surprise cash problems.
At the end of the day, it all boils down to this. A quality of earnings report is the essential machine that takes messy, raw, historical financial data and transforms it into the clean, actionable intelligence you need to make smart, multi-million-dollar decisions. It makes sure you're basing the deal on reality, not just a good story. And with that, our investigation is closed.